When a developing nation wants a quick economic boost, they often look for foreign megaprojects. We're talking about massive investments. Think deep-water cargo ports or sprawling tech hubs, labeled legally as strategic development projects. To attract these colossal ventures, governments usually cast a highly lucrative line, the corporate tax holiday. They invite the company to build, operate, and profit for years without paying local taxes. This illustrates the hidden cost. A corporate tax break on one side creates an empty space in the public treasury on the other. Every dollar the corporation doesn't pay is a dollar the government absorbs to maintain public services. In Sri Lanka, the 2008 legal framework took this to the extreme. Mega corporations were routinely handed massive tax exemptions lasting up to 25 years. Giving away 2.5 decades of guaranteed tax revenue without guaranteed economic returns is a staggering gamble. It forced everyday citizens to subsidize global corporate giants without any protection for the treasury. So what happens when a massive project stalls? What if the concrete is poured, but the thousands of promised jobs and the regional economic boom simply never materialize? Under the previous system, the government had no robust legal mechanism to claw back those lost tax dollars if the corporation failed to deliver on its end of the bargain. The state treasury absorbed the fiscal damage, meaning the public was ultimately left paying the price for unfulfilled corporate promises. The law acted as a one-way street. It prioritized shielding foreign investments from financial risk, placing the entire burden onto the shoulders of the average taxpayer. To fix this imbalance, the NPP government introduced a structural solution, the Strategic Development Projects Amendment Act, No. 26 of 2025. The amendment builds a new legal roadblock called ex ante, or before the event, cost-benefit analysis. Now, before the Board of Investment can even consider granting a tax exemption, the Ministry of Finance must rigorously audit the project's true long-term value to the country. This mandatory pre-approval audit shifts the power dynamic. It stops blind corporate approvals at the gate before they ever have the chance to drain the national treasury. The new amendment's most aggressive financial feature slashes the maximum tax holiday from 25 years down to a hard limit of just 10 years. Section 4C introduces a strict legal absolute. Under no circumstances can this 10-year holiday be extended. The legislation also patches individual tax loopholes. It explicitly mandates that all project employees, whether resident or non-resident, must pay standard income tax. By capping the timeline and strictly closing these loopholes, the government guarantees an expiration date on corporate subsidies, protecting future generations from carrying the weight of a long-term financial drain. The law also introduces an operational phase requirement, ex post, or after the event, monitoring. This is an ongoing system to track whether an active project is actually hitting its approved key performance indicators. If a project begins to underperform, the Board of Investment steps in immediately. They issue a formal notice of noncompliance, setting a specific period for the entity to implement corrective action. If the corporation fails to meet these requirements, the board is legally authorized to revoke all tax exemptions and impose administrative penalties to recover the state's financial losses. This creates a legally binding safety net. If a corporation breaks its economic promise to the country, the public gets its money back. The final pillar of the 2025 amendment extends beyond government audits. It shifts oversight power directly to the citizens. The law explicitly requires the Ministry of Finance to publish the outcomes of these megaprojects, their fiscal impact, and any notices of noncompliance directly on its official website. They must also release an annual report detailing all tax expenditures. This document will show the public exactly how many dollars these corporate tax breaks cost the Treasury every single year. By ending perpetual tax breaks and mandating public audits, the 2025 amendment tethers foreign investment to the development of the national economy.